And thanks to the panel for being here on a Sunday at 12 o'clock. Now, I think you guys have been listening to AI and the metaverse, which is all very new age. I think what we're going to be talking about is extremely old school. So we're going to be talking about M&A and debt, which is as old school as it gets, but hopefully will make for an interesting discussion. So I think you've already been introduced to the panel, and we have a very diverse panel here, and we'll be getting views. So Jaipat is from New York. He's going to be talking to us about the US practice. Manish is a banker. He's going to be bringing us the lender's perspective. Abhijit's going to talk to about UK and the European perspective. And there, from Dhananjay, we have the perspective of a large corporate, Bharti. And last but not least, from Prateek, we have a big financial sponsor in the infrastructure space, as well as, all the other sectors. So I think we can bring you a very diverse set of views over here about, I think what M&A and financing is really sort of the mainstream bit of the corporate world. It's what all of us thrive on as lawyers and bankers and business people. So I think what we'd like to talk about today is M&A is all prevalent. I think we want to talk a little bit about India M&A, how foreign investors are looking into investing into India, as well as Indian corporates are looking into investing abroad. So how M&A is looking today, and also debt. So debt is the second pillar, I would say, of the corporate world. You can't really get that far without leverage. And when it comes to acquisitions, leverage plays an extremely important role. And we'll be talking about some of those themes to see, what kind of a role does leverage play in acquisition transactions. So that, I think, hopefully sets the stage for what we're going to talk about. So I'd like to begin by asking the panel generally about their views on M&A, what they've been seeing, what the trends are. And maybe I can ask you to think about what are the geographies, what are the sectors in which we see India M&A play out, what are the type of targets, are we seeing more in the listed space, in the private space, are we seeing control deals, majority stake acquisitions, or are we also seeing some minority stake acquisitions? So just generally to get your thoughts on what the M&A trends are. So Jaipat, if I can start with you.
Oh, thank you. I am not an India lawyer, so I'm going to listen to these people who are smarter than me, and also because they are India lawyers. But I'll just add one or two comments to what Sonali said. When I started the practice of law, I looked at M&A as one transaction. But as I got into the practice, I realized that M&A is often not one transaction, but that transaction is often three transactions or more. So you have an acquisition transaction, you have a debt financing transaction, and you have an equity financing transaction, and they have to take place all together. So there is an inherent tussle between these three kinds of transactions that take place simultaneously. And what you learn from experience is that in this inherent struggle, it is the purchase transaction which often controls the terms and conditions for the financing transaction. Even, I don't know how it is in India, but in the US, that's been the trend, which means that there are no special financing outs. When I go out and do a house mortgage, there is something called a financial or a mortgage contingency. When we do purchase transactions, there is no purchase contingency. The seller would say, go and take a hike. There is no transaction taking place. In fact, the seller might say that I want a reverse breakup fee if he gets this impression that at some point the buyer may not be able to close because of financing. So financing terms and conditions often have to coalesce with the terms and conditions put in the purchase agreement. So why do I say this? Because we often view these as separate transactions, but they are in a way separate, but at the same time, they all have to merge into one. So with that kind of 101, I now give this mic to the next speaker.
No, no, 100% agree with you, Jaipat. Financing revolves around solving for paying up for the acquisition. So completely aligned. It has to be completely aligned with whatever are the terms agreed for acquisition. I think just in terms of trends, if I rewind 10 years back, there was a lot of outbound acquisition from India which used to happen. That has come down to a trickle. Last year, probably there were less than half a dozen or something which was significant. There is a lot of inbound happening, and most of it is financial sponsor led. Bulk of I think the total deal volume would be around 75 billion or so, and almost 60% would be inbound and financial sponsor led. Balance is onshore, so Indian companies acquiring other Indian companies. Just in terms of, you're going to talk about structures later, yeah. That's on the trend, and I would say most of these companies are using leverage. It's a default option. There are very few who would not be using leverage. In terms of outlook, I think given where global markets are and in terms of valuation, we are seeing a lot of deal discussions now, which are yet in the private space, but a lot of deal discussions on outbound acquisitions. Companies wanting to tie up, let's see if they close or not, but 2023, at least I expect the outbound acquisitions to pick up. 2022 also saw inbound also drop vis-a-vis 2021, just in terms of rising interest rates, etc. So I think that should also perhaps stabilize, and in general outlook for 2023 should be better than 2022, I would imagine.
Thank you, Manish. Abhijit, now you've been in Europe, you've been based in Germany previously, and you've now based in the UK. So could you tell us a little bit about how you're seeing India M&A, maybe both inbound and outbound, but sitting from UK, Europe perspective, how do you see it?
Thank you, Sonali. The title of this conference is Law in the Age of Globalization. So before I come to the India situation, I'll just look at what is things looking at on a global perspective. If you look at the numbers of 2022 and compare it with the year-to-year 2021, in terms of the pure deal numbers, there has been a 40% decline. And a similar, very ironically, a similar number of decline in terms of the percentage of deals was witnessed in Europe. And that's the way it is. And as Manish rightly pointed out, rising interest is one of the reasons, but then there are other reasons that we'll get into later. In terms of India, I think as again Manish rightly pointed out that we had at the beginning of say 2007, 2008, I think we saw a lot of overseas large deals, especially by Tata, acquisition of Core Steel, acquisition of Jaguar Land Rover, some of the really large transactions. But over the last years, or more recently, I think deals are still happening. I wouldn't say that it has been a complete stop, but it's more of a trickle. We are still, when I look at investments by Indian companies into Europe, we've seen deals happening in pharma space, whether it is an acquisition of a pharma company or just acquisition of a portfolio of drugs, because that is where the Indian company thinks that they need to grow. We've seen a lot of investments, continue to see a lot of investments, especially in continental Europe in IT. So whether it is Wipro, whether it is TCS, whether it is Infosys, they are doing acquisitions because a lot of the companies or the client that they want to get the work from are not interested in so much in offshoring, they're interested in onshoring. So you need to have people on the ground in those countries to generate, those big headline grabbing deals. The other sector where we have seen deals and continue to see deals even now is auto components. Some name that you must be familiar with is, say, Motherson Group, which is by far the largest auto component manufacturer in India. They have very ambitious growth plans, and I think just recently they did an acquisition in Germany, which has an enterprise value of about $500 million. We had seen previously some acquisition in the automotive space, especially Mahindra did a few in Germany, But in the last, say, 5, 6 years, we have seen more in the auto component space. And that is a sector where I think more Indian companies will still do acquisitions. We as a firm have advised some clients in that space. Minda, for instance, is a good client that we have done some work with. The other sector that we have seen some deals are, say, engineering, manufacturing, in some cases also services. That's for now, and then I think about the larger macro picture, we'll get into it once we proceed further. Thank you.
Thank you. Really, I think in my view, in terms of the sectors historically where we've seen in 2022 a lot of action, really if I talk about just the listed deals, a lot of us would have picked it up from the media and even otherwise personal information being involved in transactions. There were a bunch of deals, really bulk deals that happened post, let's say, Zomato's listing or Delivery's listing, right? A lot of the private equity players, there were a huge number of bulk deals that happened August 2022, as recent as Delivery, the KKRs and SoftBank. A lot of these large ticket issues, large ticket deals happening by a lot of these private equity players. Because really, and I think what prompted it in my view was when these startups really went in for a listing, obviously somewhere the market sort of didn't perceive the listing, it didn't go down too well, and therefore the shares really, I think they were trading at maybe the price which was really lower than what the expectation was. And therefore, when the market corrected and when really the share prices moved up, that's when a lot of these bulk deals happened. So much so that, in August, some of the largest big deals on the bulk market happened, bulk trade happened where HDFC, I think Max Life, Max Health, that was a huge transaction that happened on the stock exchange. In terms of the non-listed deals, I think in terms of the minority deals, we've seen a lot of these minority deals being a lot of these e-commerce players like the Flipkarts and the Amazons of the world. And typically the model that they follow is when they do these minority deals, they will, because of, and really the objective of them doing these transactions is driven largely by what other e-commerce players do in the market. And typically you have to understand the Amazons, Flipkarts, and the Reliances, they are really aggregators when it comes to e-commerce. So what they do is they will obviously, by virtue of doing these minority deals, pick up a 10%, 12% stake. And on the side of the M&A, they also have strategic partnership agreements. Now, what this partnership agreement does when you do, along with the investment, you may not be having a lot of reserved matters. You may not be having, let's say, even a board seat. That's not important. What is important for these e-commerce players is to really, by investing that 10%, 5%, actually have a strategic block on the other e-commerce entities from picking up stake in these smaller players. So that was a key driver. And just to give you numbers in terms of Flipkart, Flipkart probably did between 2021 and 2022 close to about 15 such minority transactions, along with obviously at the back of that having these strategic partnership agreements. And maybe we can touch upon this a little later. The one big question by doing these strategic partnership agreements was whether it falls foul from a Competition Act perspective, because therefore you are creating an exclusive supply partnership agreement, and does that really fall foul, or is that subject to putting the companies from a competition law perspective? Are you exposing yourself to scrutiny at a later date? I think really the answer to that would be, of course, multiple factors. But really, I think the takeaway was to say that, the value of the deal plus the market presence was so small, so therefore there was no really appreciable adverse effect on competition, and therefore you had an arguable case, a good defense to say even if the CCI were to come back and sort of investigate this. In terms of the trends, in my view, I think there is post-COVID on the health, pharma side, there's been a lot of action that continues to pick up. Other than that, EdTech has been very active. We all know the likes of Byju's, regardless of the wrong reasons that they were in the news for. But really, I think in the edtech, be it Byju's, be it PhysicsWala, there's been, Byju's, for instance, has done more than about 10 or 12 acquisitions in the last 1 year. Even again, PhysicsWala, I know for a fact they have a dedicated sort of M&A budget to go out. So we will continue to see, and we are seeing a lot of consolidation in the edtech space. I think gaming is another area, in my view, which we will see a lot of action. And why? Because one, obviously, from an Indian regulatory perspective, I think the regulatory regime is not very clear. That's one. And two, I think the GST impact just on gaming is really high. So therefore, a lot of these gaming companies will see or will look to set up shops outside India and therefore, wait for the right moment to sort of come back to India. And maybe we can speak about it a little more as the session progresses. Thanks.
Hard to go after a lot has been spoken about the trends, but maybe I'll talk a little specifically about trends from a financial sponsor perspective. So as a global financial sponsor, we largely invest out of global funds. We don't have regional funds. So keeping that in mind, the trend that we've been seeing, say, over the past 6 or 9 months since the Fed has started increasing the rates, and which has of course has had a trickle-down effect on India as well. What we've seen is that there's a lot more M&A activity, a lot more attractive M&A opportunities in North America, flowing to Europe, and India has started getting there only in the past 2 or 3 months, given that India has had rate increases, which so the financing rates have gone up, which is where we find investment opportunities go up. So we expect, as a financial sponsor, we expect the next 6 to 9 months to be very active in the region. On the types of transactions, as Sonali mentioned, whether we're looking at more control, more minority. I think India historically, for most financial sponsors like us who are doing larger transactions, we would like control transactions, or at least significant majority transactions where there is enough influence that we have over the companies. Honestly, minority transactions are a lot riskier. So in larger assets, we would avoid them unless these are strong promoter-run companies with strong cash flows, etc. And from a listed versus private, again, purely from an infrastructure renewables perspective, it would largely be private transactions. Listed would be more in like the others mentioned in healthcare, Beta Max, or in other transactions there may be minority listed transactions. Again, listed, the other bit that we face is the delisting regime, and take privates, which are easier in other parts of the world, are not as easy in India from a regulatory perspective. So we find that hard from an exit perspective, unless, again, we're doing a minority and we can exit through a bulk or a block, like Dhananjay mentioned. So, yeah.
Great, thank you. I think that gives us a really good perspective of how M&A is looking in the India context, just in the last 12 to 24 months. Now I'd like to move a little bit to financing. And here I want to invite Jaipat and Abhijit to give us an overview from a US and a Europe/UK perspective. Because if you look at what's happening in leverage finance in India, we have followed the trends both from the US as well as Europe. Both in terms of who's providing the debt, what are the structures which we use, what do the documents look like. I think there's been a lot of influence both from the US and Europe. So can I invite you to just talk about what's happening in the US? What does the LevFin market look like?
Thank you. Thank you, yeah. So one of the messages which you all must have gathered from what all of these people said, and that is reflected in the trends, and I can give you numbers also, is that deals today follow financing. If there is no financing, there are no deals taking place. Prateek mentioned about interest rate, and you mentioned about um, the trend up and down. So let's look at it. In 2021, at the US end, we had about 1.5 trillion, 1.5 trillion dollars worth of deals. It went up in 2021 to 2.25, and then 2022 it came down again to around 1.4 trillion dollars. In 2022, the interest rates went up from 25 basis point to 475 basis points, which really means that the money flow dried up tremendously. Ordinarily, when money flow dries up, people start going to the stock market to raise money. So what happens in deals is that ordinarily you have a stock purchase, an asset purchase, or a merger. These are the three main forms in which we do our transactions. But when cash becomes less, you'll start seeing an uptick in merger transactions. So there is less use of cash. You'll start seeing more earn-out transactions. You'll start seeing more holdbacks. You'll start seeing transactions where the use of stock as a currency goes up. So this is the trend which we have already begun seeing. We have also started seeing that the impact of financing is reflected in India deals as well, which means that when in India financing was easier, which was at some point, there were a lot of outbound transactions. And when financing became a little difficult in India, outbound transactions kind of went down. And who was bringing the inbound transactions? Again, the financing people were bringing the inbound transactions. That's happening in the US as well. After Lehman Brothers, I think Prateek mentioned that he left the US at the time. So I was reminded of it, that after Lehman Brothers, we had a situation where there was so much uncertainty and doubt as to what kind of regulations we should be having in terms of which would result in control over the financial institutions. So finally, after 5 years, in 2013, we had interagency guidelines on leverage, to the point which Sonali mentioned. What it did was that it pretty much slowed down traditional financial institutions and banks from being big players. Earlier, they were the ones who were financing the LBOs. All of the leverage buyouts were coming out of big financial institutions, not after 2013. After 2013, what we saw happening was that the private market, the private equity market, the private players, the non-banks, they become bigger players. So what you see in India is probably a microcosm of what's happening in the US, which is that the sources of funding have shifted towards private equity. They are no longer of course they do the syndicated loans, there is no doubt about it. Public company transactions, yes. But when it comes to private transactions, which is where I am, I see virtually no financial institution playing a big role in acquisition financing. They may be doing asset financing, but not really focused on acquisition. So if I look back at this period of time, as I said, consideration is also changing. It will no longer be a cash-dominated transaction anymore, at least in the near term. Why? Because the stock market has also been in doldrums. So sources of cash, ordinarily one would flip from debt to equity. But the sources of cash, if they are uncertain, we will end up using stock, which is deferring the encashment of the stock, but certainly using it as currency today. So instead of 70% of the deals being cash deals, we will see a shift. They will become like 60% of the deals are cash deals. Others are a combination of cash or stock for that matter, or mergers. Unlike India, mergers is a big thing in the US, at least at the private level. Mergers is the most important way we can get around these issues because it saves you from spending cash. But merger is a little more difficult process in India. That's a different topic.
Abhijit, if I can request you.
So for me, it's a little challenging because Europe and then talking about UK. So it's a lot, because Europe, we're talking about different countries and then UK has a different flavor. So I'll give a more, say, overview. I think a bulk of the discussion that we are having today is about financing. We know that whether it is the Bank of England, whether it is the European Central Bank, whether it's the US Federal Reserve, they have all increased their interest rate, thereby directly hampering the amount of loan that was being given by lenders. And this has impact on both the financial sponsors like Brookfield. I'm not saying that you're hampered by it yet, but I'm just saying that it will affect the ability of financial sponsors to consummate big deals. Small deals still will continue, but big deals will be greatly affected. One. Then we talk about strategic players. Their ability also will be affected because they will be drawing mostly from their cash reserves. That also puts a strain. If you look at what happened in 2022, there has been a decline of about 69% in the western and southern part of Europe in terms of the loan issuance. 69% from what was done in 2021 and what was done in 2022. To give you some numbers, in Q3 of 22, loan issuance in Europe was about $26 billion. In Q4, that number came down to as much as $4 billion. You see the big difference. And that, it's not a surprise that we see a huge difference in terms of the decline in the deal. But I think an important point that has to be made when we talk about a substantial decline in deals from 21 to 22 is the fact that the deals that we're seeing in 22 is still reflective or are at the level of the deals that we had in a pre-pandemic period. So it's not like, it has been a long phase of bad deals. It's just that it has gone back to the pre-pandemic because I think everyone agrees in this room or I guess on this panel that 21 was unprecedented. Any comparison of 21 with any year will be a challenge, In terms of financing, of course, there's an immense pressure. There was a very interesting survey last year done, and that was quite representative because it was a survey of 240 corporates based in US, Europe, Asia, and about 90 financial sponsors. They said they believe in the next 12 months, and this was a survey done last year, they believe in the next 12 months the deals will be financed in the following proportion. 62% believe that the private equity will continue to make the financing possible for deals. Then came the non-banks or say credit funds they will support. And the third most popular response was about cash reserves. Jaipat mentioned about syndication. Syndication, at least in Europe, from a European perspective, is also a challenge. I believe that there is a number that US and Europe banks today combined are sitting on, say, about $40 billion loan that has to be syndicated. That's a huge amount. Thereby directly impairing their ability to, finance bigger deals. I talked about how, one of the responses was, if not private equity, we're looking at credit funds. But when you take money from credit funds, we're talking about smaller deals. It will not be as big as the typical deal that you see, which was either heavily leveraged or we're talking about a leveraged buyout.
Thank you, Abhijit. That is a very interesting perspective on what is happening in the global markets. Now, Manish, if I can ask you, so you represent a large global bank. So as a funding provider, how do you see these challenges? Do you see private equity competing with you to provide finance? Or is it more collaborative in that you'll set up the deal, but you also have these alternative sources who can join the syndication? In India, it's a very funny market in terms of debt finance because the Indian banks really can't fund equity financing. So the foreign banks, the banks sitting abroad have been doing this for the longest time. But now we see all these new players like private credit, and indeed for that matter, private equity. The flip side of private equity itself is funding. So it'll be good to get your perspective on how, do you see these competing sources, collaborative sources? How do you see it?
No, it's very, I think India is very interesting, especially given what Jaipat said and Abhijit said. So, as I initially said, there's a lot of inbound activity and by financial sponsors. And all of that is debt funded. You know, part of it, let's say LTV of 40% or so, that is debt funded. So I guess banks such as ours are active in that space. So that is one. Just in terms of onshore, I think echoing and outbound, so that's inbound. Outbound, there are a lot of deal discussions, and again, that would be funded by banks such as ours and including Indian private banks. Discussions as of now, I think you mentioned Motherson, Abhijit. So that's one example which is already announced, and there are a couple of others, which are discussions are ongoing, and some of them can be very large. So those deals may consummate in 2023. Almost any bank can fund those acquisitions. They are permitted. Indian banks can fund them too. The interesting space is onshore. Sonali mentioned Indian banks cannot fund it. Foreign banks can. But what we are seeing is mushrooming of the private credit space. So let's say the likes of Kotak or Edelweiss or a lot of private foreign financial sponsors setting up private credit arms. And so this is more in the smaller ticket size, let's say, right from 25 US million to about 100 million US. So that ticket size, there is a lot of activity which is currently happening. And that's very, very interesting. Just in terms of yield, just in terms of structures, just in terms of credit challenges given the small size. And a lot of funds are being raised by private credit guys to support that segment, which I think should see a big uptake or a big growth in 2023 and onwards. So that would be a fundamental change, I think, in the Indian market, just in terms of alternate credit providers coming in. And I think foreign banks should also be, banks such as ours should also be able to play an increasing role in that, just because of the flexibility of vehicles which we have, which is, be it an FPI, which can fund onshore acquisitions, or NBFCs. Most of the foreign banks have local NBFCs, which again can fund onshore acquisitions. So there is a bit of flexibility we have. NBFCs as a segment, went down in the last 2 to 3 years, whereas foreign banks or their NBFCs were not impacted in terms of the funds they were able to raise. I think just deal availability is there. There is a lot of activity, and private credit should be playing increasing role in funding that space.
So you mean to say there will be more deals but smaller deals?
Yes, there are. Just in terms of number of deals, deal volume would be far higher, but not in terms of deal value. But just in terms of, so if I was to say IG space, despite the yields having gone up, IG space is still SOFR plus, let's say ballpark, 150 bips. Financial sponsors, when they are acquiring companies in India, they are more in the, let's say, ballpark 400, SOFR plus 400, 450 range. And obviously the leverage levels are, on an attributable basis, are quite high. This segment, given the size, it's even, I would say SOFR plus 700, 800 pips. That's the yield play which is there in this segment.
Yeah, expensive, but there will be deals, more deals, but smaller deals.
Yes, and a lot of activity. There's a lot of activity in this segment.
Thank you, Manish. So just staying on the funding sources, Prateek, maybe a question to you. So as a financial sponsor, you guys are known as serial deal doers. You're always looking for deals. So how important is leverage in that spectrum? As in, is it a must-have? Is it a nice-to-have? Is it a sweetener? And then, how do you find the funding sources? You think it's good enough? The market has depth, or there could be a lot more, as compared to in other jurisdictions. And like you mentioned, your funds are being chased by various jurisdictions. So if leverage is easier in another jurisdiction, maybe the funds are going to go there. So, just give us your perspective as a financial sponsor.
So as a financial sponsor, which is effectively looking to deploy out of their now fairly large funds that we have, it's always tricky on how much leverage we take, because on the one hand, we need to deploy the LP's money that we've raised, and we can't rely just on external financing. But like you said, it's always a sweetener. It always helps to, if I can say that, pass on part of the risk to another financial institution. And to what Manish said, and on your question on whether you're competing with private equity, I think not. From what we have seen, banks are also happy if they are backing a private equity player, or coming in, if it's a pure debt transaction, coming along with a private equity player, because they know that there is the level of governance, the global expertise that a global sponsor would bring would always help the asset. So from our perspective, we do see value in getting financing. From a structure perspective, like again you said, India is obviously not there. More specifically on the acquisition financing side, Indian banks don't do it. With the newer structures of InvITs, etc., there is a move in the positive direction for sure. But even today, from an acquisition finance, we're largely reliant on either NBFCs or foreign books, the books of foreign banks which are sitting outside. Or we are looking to do back leverage transactions outside of the country, and effectively, more specifically for infrastructure or other stable cash flow deals, we are able to do that offshore. But again, keeping in mind, it needs to keep in tandem with the equity that we are investing. In terms of ease, for sure, what we find offshore is much easier. Like Abhijit mentioned, that it is a difficult market for sponsors as well. It is, for sure, given the way the rates are. But given the current environment, what we've also seen is, again, banks are more than happy, financial institutions are more than happy to back the right player. For example, in the midst of, or rather just before the rates started hiking up in the US, we raised about close to $8 to $10 billion in the US market for one single transaction, which was the Intel transaction. So given the right transaction, given the right strategic partner and the financial sponsor, we see that financial institutions are ready to back deals even in this market.
Yeah, that makes a lot of sense. I maybe want to spend 5 minutes on outbound transactions. So outbound, like I think people on the panel have mentioned, it's had its ups and downs. There was this phase where Indian corporates were really going out and buying these big targets. There was some criticism that there is a lot of leverage, and that level of leverage is not sustainable. I think there was a phase when people were really more focusing on the domestic market. So it's had its ups and downs, but we've seen some really large transactions by large Indian corporates. They've gone out to every continent. We've seen a lot of deals in the US. We've seen deals in Europe. We've seen deals in Africa. So really, Indian corporates have been out there as strategic buyers to go and invest in every segment of the market. And we've recently had an overhaul of what we like to call the ODI regulations, or the Overseas Investment Regulations, wherein the government has tried to make it a bit easier for Indian corporates to go out. And of course, there's a whole side of individuals going and making investments as well, but also for corporates. And what the government has tried to do is to make it a little bit more simple, wherein it's left to the corporate's judgment of how they're going to go out. Of course, there's still financial parameters of how much you can invest. But beyond that, rather than police everything and be very prescriptive, the new regulations have tried to make it more simple for Indian corporates to go out and buy targets and also take financing. And the financing market for that has been quite established. You go out, you set up a bidco, you take financing in the bidco, you give security over the assets of the target, you will maybe have a corporate guarantee from India to provide credit support, and then if something more is required, maybe you'll have some asset security from India as well. And the new regulations have tried their best to make this a bit more simple. So maybe if I can ask the panel, Dhananjay, as a large corporate, you guys have invested everywhere, you've invested in Africa. Do these regulations actually make a bit more sense? How is the outbound picture looking for you?
Yeah, so I think in terms of the outbound, really my view is a lot of these large business houses, they really, I think a couple of years back, if we look at maybe 5-6 years ago, it was really these large conglomerates that were really the drivers of outbound. And like I think Abhijit mentioned, I think the one important aspect is getting the timing right. And the reason I say this is because when the Chorus transaction happened, the acquisition, I think while the balance sheets obviously post that deal, it probably portrays a very different picture. But I think from a timing perspective, that really didn't go down well. As opposed to that, maybe when the Tatas acquired Jaguar and Land Rover, I think it worked and continues to work very well for them. For us, yes, we, of course, as a large business house, we, of course, went into Africa, slightly dated, but yes, we did set up the entire sort of Africa business operations. In terms of the other outbound activities that I look at, like I mentioned, I think health, pharma and health space is one area which will grow and continues to grow. Last year, one of the key acquisitions was really in the by Biocon. I think it was in the biosimilar space. That was one. I think fintech is another area because I feel a lot of the fintech players within India, I think the key driver for them to go and make these overseas acquisitions is, one, it's driven by the fact that they want to tap in the overseas technology space. They want to tap in the, and again, this obviously holds for true for any sector. So one is, of course, technology plus the talent, and two, of course, the access to a larger market. And one interesting fact is, till about 2021, really for India, in terms of outbound transactions, it was more sort of Europe was really the geography which was sort of the preferred geography. I think in 2022 that has sort of shifted Europe, and now it's US. US is really the in terms of the volume of the transaction that have happened from India, US is really on the top spot. And I think, again, in going forward, 2023, yes, it will continue to be US. It will be driven by somewhere I feel my personal view that in the Indian market, I think there is some sort of a saturation that has already been reached for a lot of these players. And with debt being easily just more like private credit being available, just the banks being wanting to extend debt, despite the Fed having raised the interest rates, it's still not very at a level where it is hurting a lot of the Indian companies, and therefore they will obviously look to still make the maximum use out of it, sort of take leverage and try and consolidate by going out to these foreign overseas locations and hunt for obviously the best talent and look to expand, get the technical know-how, and obviously integrate the domestic and the offshore businesses so that from a scalability it just works well for them. Yeah.
Completely agree, Dhananjay. We've also seen that US has really emerged as a destination where we see, and because of the sectors as well, because tech is clearly, one of the sectors which is on top of everybody's mind, and see, we do see a lot of Indian companies going out into the US market. And I think the panel was talking about, for example, Byju's as well. So Byju's went out and did a very big term loan B in the US market. I think that's only the second term loan B, significant term loan B, which has been done out of India. I think there was one before that. So that was very interesting to us because this is a new market of US institutional funding, not banks. Jaipat, any thoughts on, how this is inbound into the US, I guess, and have you seen that a lot? Again, you mentioned banks versus other sources, so some thoughts on that.
Yeah, absolutely. There is a constant flow of deals at a smaller level, much more today than ever before. The sad part is the absence of domestic support in terms of financing. Unlike the US, where the domestic market for transactions is humongous, in fact, there is virtually no conversation of inbound and outbound activity because we are so overwhelmed with domestic transactions. Unlike that, here the transaction, it seems that the domestic market hasn't quite leaped to a level unless there is more domestic activity and need to find strategic fits. More outbound transactions won't happen. People will have to first do roll-ups here, become stronger, and then go out and look for acquisition targets. That's not happening. Quite the contrary. They have a limited base in the country, but they are going out to the US because they think that the opportunities to do things within the country is less. But maybe United States would become the primary driver for their business. I'm also seeing businesses coming and saying that they want to incorporate or reincorporate into an American company or a Delaware company with the parent being in Delaware and the sub being in India. So clearly it is a more enthusiastic space to come into. So in terms of deal activity, most of them are not getting domestic funding unless it is a target which has a revenue stream. And that is a challenge. If there is a revenue stream, debt will come. Debt follows revenue stream. What we will end up seeing would be more of collateralized transactions for raising funds. There is no other way fund is going to be raised other than through more and more collateralization, which means that the target cannot possibly be an entity which is thin on capitalization or thin on assets. So we will see more asset-based lending for that because there is really no domestic support that I am aware of for these businesses trying to come to the US.
One, especially when we talk about Indian companies going and doing acquisition in the US, and I completely agree with Jaipat that these will be there and smaller in size for obvious reasons that we're discussing. I think a new short point on that, a new range or a new breed of acquirers has to be talked about, and these are the startups. So Indian startup ecosystem is one of the very good success story in the last few years. We have over 100 unicorns, etc., etc. But these companies are not just growing organically, but also growing inorganically and pursuing very actively acquisitions across different space. We did touch upon the acquisitions, series of acquisitions by Byju's in the US and also in Singapore. But it doesn't begin and end with Byju's. There are other companies, especially say SaaS-based companies, software as a service based companies, which are pursuing a lot of acquisition in the US. And many of these countries, of course, we're talking about a funding winter, and will not move to discussing more on VC side. But many of these companies are raising funding because they are basically interested in pursuing inorganic growth, and very familiar with the concept of Indian companies, even in the startup side of things, flipping their headquarters to Delaware, which is a very popular place for good corporate laws, and then raising funding, because that is the precondition of raising funding by any well-established US investor.
Thank you, Abhijit. So I think we have just about 8 minutes left. I'd like to spend a little bit of time on inbound. So inbound, obviously, FDI is a huge, huge source of activity in the entire industry. We're all working on FDI deals, at any given point of time. Prateek touched a little bit about what are the structures which are available. So either you have a financial sponsor or a global corporate who's sitting outside. They want to come into India, they want to take debt. How do they do it? The most simple method which is available is that they're going to take debt offshore, and then they're going to use that and put equity and buy out the existing shares. That's the most common structure. But then there might be reasons to do the debt in India as well. You maybe want INR funding, you don't want US dollar funding, because the underlying revenues are going to be in rupees. So then if you want INR funding, how are you going to do that? It's quite limited. Either you're going to set up a vehicle in India and take debentures which are denominated in rupees, but from some offshore sources, or there's some limited avenues to do fundraising in India. So, and it's not, you can't get security over the target's assets in India. You can only get share security offshore. So there are quite a few limitations, I think, on how inbound financing is done, but it's still a very flourishing market. And so what I want to ask the panel is that when you're considering an inbound M&A transaction, so Prateek will look at it as a financial sponsor buying into India. Dhananjay may look at it where, let's say, a financial sponsor is buying a stake in one of your companies, maybe a minority stake, and they're going to put some financing behind that. And then, of course, the bank is sitting behind all of this. When does sort of thinking about financing enter into the M&A transaction? Is it on day one you start thinking about both M&A and financing? Or you progress a little bit on the financing, on the M&A, and then start thinking about it? When you're drafting your SPA, do you think about lenders? I just want to get a view from the panel about, where does financing sit in the course of the M&A transaction? I think, Jaipat, you mentioned that there are really 3 separate transactions, but they drive each other. But maybe you can give us some thoughts on this.
So it depends. For a strategic buyer, the desire to seek a target is strategic. And therefore, clearly, that comes first. Financing follows. There is no ambiguity on that. For a private equity player, they are sitting with funds and need to devise a strategy in a certain space. So they are driven more from their perspective. So for them, the strategic thing is to be able to deploy the funds right. But to your point that what is the tradition, what is the source of funding? Is it being raised domestically here? I have been involved in all the deals that I have been involved in. I have not had a situation in which the funds were raised in India. Funds were raised overseas and they were deployed here. They may have been raised as debt, but they will be deployed as equity. And so to that extent, they did not, at least so far, did not have situations where they could have collateralized the target's assets. So the entity which was doing the buying, it received, doing the borrowing, received guarantees from their parents, from the sponsors, commitment letters being, equity commitment letters being shared. Unlike, I think in India, there is more difficulty in giving related party guarantees. I think there are regulations associated with it. Not so in the US. So the ease with which we can give, the only restriction would be that you have entered into some contract which restricts you from doing it, but it is contractual in nature, it is not regulatory in nature. So the use of guarantees or guarantee equivalent kind of enforceable document is very prevalent for these kinds of transactions.
And Manish, are you happy with the way your borrowers are structuring their M&A transactions? Are they thinking about your requirements as a lender enough, or is it a bit of a struggle? Have you seen a change in the M&A transactions maybe?
I think most the CFOs and the treasurers of most large corporates are aware of the terms at which financing is available. So unless it's a multi-billion-dollar transaction, I think they will pretty much progress, keeping in mind that the financing is going to be available on certain terms, which to my mind they are by and large aware of. Only if it's large transactions, they approach banks upfront, and we kind of give them or ideate with them, like we had a couple of large, say Adani Wholesale like trades, where the banks worked with the corporates to structure large financings, which had multiple tranches to it. So unless those kind of trades we are talking about, I think the market pretty much works very seamlessly, just in terms of each party knowing what the requirements of the other party would be.
Thank you. Abhijit, as a lawyer working on M&A transactions, are you seeing something different? Are you seeing a bit more of the financing come into the document? I don't know, maybe in confidentiality clauses, some other clauses, assignment clauses. Do you see the impact of debt finance really on the M&A process?
Short answer, yes, absolutely. I think banks know, and even the buyers know, that the banks are in a much better bargaining position. They're able to dictate terms. They can have more stricter covenants in the documents. So it is getting a lot more challenging. Keeping my input short because of the time that I've seen.
Any other thoughts, Dhananjay, Prateek, on this bit?
So I think to answer your question, at what time should we look at financing? I think from day one, and I'll tell you why. Practical example, I'll just make it very quick. Back in 2012, without getting into the nitty-gritties, we were doing a transaction, and this was in relation to the spectrum auctions. Now, back then, the model, the structure that was followed by a lot of these offshore foreign entities was obviously you needed to, because of the FDI restrictions, you needed to first come, bid, make the auction, seek approval from the FIPB. And once you get the FIPB approval, the foreign investor could obviously increase its stake, and the domestic player who is partnering with the foreign investor for the spectrum auctions, you could obviously post FIPB approval. The domestic players' shareholding would go down, and the foreign partners' shareholding will go up. Now, during this period, in fact, I was personally involved in a transaction, and we had not thought about, we were the Indian partner, and we were partnering with a foreign player. We had not thought about financing at all. We reached a stage where we completely agreed on the SHA. It was really at that point in time that we figured out that we needed actually to approach a bank and get the bank to agree to the terms and finance us within the 2-3 days, because the auction date was hypothetically, let's say, 8th of March. And we were sitting already at 5th of March with 3 days, because if you didn't get the bank financing lined up, you would lose the deal. And really, we did lose the deal because obviously this foreign entity who was coming into India to bid for the spectrum allocation had obviously was already in discussions with 2 to 3 Indian players. And in that, because we had not really lined up bank financing upfront, we really lost out, and it's really the foreign partner went with the other domestic partner. That is one, and I think two, it's very important, just very short point to, I think what Jaipat was saying, a lot of the times we see, because the documents are interconnected, right? You have your SPA, your SHA. Really, when the bank comes, they would obviously, because they are giving the money, they are providing the debt, they would obviously want to see how well protected they are, what is the risk that they are taking in terms of the documentation. And really, for two players where, let's say you have an investor investing, his approach to what the governance, what the reps, what the events of default should be vis-a-vis the entity which he is investing in, the lens with which he approaches it, vis-a-vis the lens with which the bank approaches it, is very different, right? So you need to have the financing documents completely in sync and sort of talking to each other with the equity documents. So I think, yes, to cut it short and to the point, it needs to be on day one, just to, if you are clear you need financing, and why not? Because its debt is cheap currently. So I think you should go on and get it all lined up on day one.
Final thoughts, Prateek?
Yeah, I agree with the panel on we need to, and more from a financial sponsor perspective as well, when the initial financial modeling is happening, like Dhananjay said, usually the cost of capital of equity is higher than of the debt. So if you are putting in, if you do plan to put in debt, you would do it on day one. You'll plan for it on day one. And from a documentation perspective as well, depending on the security, the bank or any other financial institution would want assignment rights and things like that. And you can't at a late stage go to the counterparty and tell them that, oh, by the way, we want these XYZ things as well, which obviously doesn't work.
Absolutely. Thank you. And thank you to the panel for a most... There's a question. We have a question.
Clarification also, and I think I'm going to be addressing Abhijit and Mr. Jaipat's point. So Abhijit, you mentioned that these flip or externalization structures that are happening where most Indian founders are looking to incorporate their headquartered company or the parent company in the US. I'd beg to differ because I work for an accelerator. I'm the India legal head there. And the reason they're looking to incorporate in the US is not necessarily for inorganic growth. Reason being because YC, for example, is an accelerator that does not want to deal with RBI. It will not have anything to do with a founder startup that is incorporated in India. Number one. Number two is the SaaS market, per se, US being the mecca for SaaS. The clientele, the target audience, everything is sitting there. You're earning $1 as opposed to a rupee here. It's software as a service, so the dynamics are really different. For example, Tally as a company, the accounting company Tally shut down in India because there were no takers. So just letting you know, it's inorganic growth, definitely, but I don't think it's necessarily that. And to add, I think Mr. Jaipat mentioned that the domestic market is not ready, even for these kind of companies, right? SaaS is way ahead of its time for India in certain ways, I feel. The target audience is still not ready for that market.
Quick response. Agreed about how they are not interlinked, acquisition and flipping. The reason I could not spend much time on elaborating that is because A, positive time, B, this is not a session of VC, we'd love to talk about it at length, but they are not really interlinked. What I'm saying is that in terms of phenomena, in terms of the two separate phenomena, one, acquisitions being pursued by startups at different level of funding, with different level of funding. Second, a lot of startups exploring or doing this flip. So they're not interlinked, but that is two steps of what is happening in the VC space in India.
Totally agree with what he's saying. Familiarity doesn't always breed contempt. Familiarity also breeds other things. And once these smaller companies get used to the fact that their customer base is overseas, it has nothing to do with financing. But the ease of being able to engage and be able to spread your wings, that is the prime driver for a smaller company. It is not connected to the issue of acquisition financing. They are really looking to spread their wings in their customer base. So, and there is ease of raising funds there as well. So clearly those kinds of considerations play a role. It has nothing to do with the issue of acquisition financing. Thank you.
You said US is mecca for SaaS companies. US is also the mecca for funding, especially in the VC space.
Any other burning questions? I don't see. I think we well past our time. Thank you very much to the panel for this interesting discussion. I think we've really earned our lunch. So, thank you. Thanks, everyone.